The current price for Rezolve AI PLC, RZLV, stands at $5.83, reflecting an intraday movement of minus 6.57% as of 1:30 p.m. EDT on October 9, 2025. That's a significant drop from yesterday's close, but here's the unexpected wrinkle. This sell-off is not purely a reaction to the stock's challenging financials, which is the default narrative for a small-cap tech name. Instead, a large part of this recent volatility is directly linked to the company's aggressive and controversial M&A strategy, specifically the recent acquisition of Subsquid, a decentralized blockchain data platform. This move, which was announced just hours ago, dramatically changes the focus from being a pure-play AI commerce company to an entity building out a digital asset and payments infrastructure for the AI economy. This strategic pivot introduces a whole new layer of technical, regulatory, and market complexity that few retail investors or even institutional holders had fully priced in, and the immediate market reaction shows a clear hesitation. For a company like Rezolve AI, which has already seen its stock fluctuate wildly, leaping from a 52-week low of about $1.07 to a high of $8.45 in a matter of months, this kind of strategic gamble is either the making of a massive winner or a catastrophic blow. The common understanding among traders who follow RZLV is that this is a quintessential speculative growth stock riding the enormous hype wave. They see the name, they see the high annual recurring revenue growth targets, $150 million ARR exit rate for 2025 and $500 million ARR exit rate for 2026, and they think of the massive multiples assigned to established firms like Nvidia stock. This expectation of high growth and high valuation has been the primary driver for the massive appreciation of over 450% in the last 6 months. However, the reality is far more complex. The company's actual revenue in the first half of 2025 was only $6.3 million, and its net loss widened significantly to $57.9 million. So you have a deep disconnect. Phenomenal projected growth anchored by a low current revenue base and massive losses. The stock is essentially trading on a promise, and the institutional activity underscores this split opinion. While firms like BlackRock and Vanguard have recently increased their positions, signaling conviction in the long-term AI story, the overall institutional ownership percentage is still relatively modest for a name of this caliber, and the heavy daily trading volume, over 12 million shares traded today, which is substantial, reflects intense short-term sentiment-driven trading and positioning rather than deep-seated conviction. This high-volume drop today therefore challenges the simple narrative that RZLV is just a fast-growing AI play. It's now a payments, AI, and crypto infrastructure play, a Frankenstein model that adds risk. To understand the current stock movement, you have to look at the recent news flow beyond just the earnings figures. The acquisition of SmartPay just days ago, and now Subsquid, signals a sudden rapid move into the infrastructure layer of digital commerce and payments. The market consensus, especially amongst generalist online investing enthusiasts, sees AI and e-commerce as simply a better chatbot, which is what the initial pitch for Rezolve's Brain Suite, including Brain Commerce and Brain Checkout, was about. But the reality is that the new focus on integrating blockchain data and digital asset payments, including a Subsquid token that will be integrated into Rezolve's treasury, is a completely different business. It suggests that management believes the next layer of commerce will require digital asset native payment rails, and they're trying to build those rails from the ground up through M&A. This is a very expensive, complex, and potentially distracting strategy for a company that is already deeply unprofitable and navigating significant legal challenges, namely the ongoing litigation with Yorkville and JBAM over a prior financing agreement. The legal overhang adds a layer of uncertainty that any intelligent portfolio manager would flag immediately, as potential damages in the hundreds of millions of dollars are being suggested, even if the company's defense is that no funds were exchanged. This kind of legal battle, combined with sudden strategic pivots into a completely new tech stack, is what's truly fueling the recent volatility and the sharp downward pressure we are seeing today. Investors on platforms like Robinhood, or those using Schwab Intelligent Portfolios, might be drawn to the AI buzzword, but the deeper analysis reveals a high-stakes bet on a hybrid tech stack that drastically increases execution risk. In terms of market mechanics, the stock's recent ascent was aggressive, suggesting it was running hot. The rally in September that saw the stock hit its 52-week high was likely driven by the half-year earnings announcement on October 1st,
where the company reported a massive 426% year-over-year revenue increase to $6.3 million. While that growth rate is phenomenal, it's coming off a very small base. The market initially reacted positively, with the stock briefly soaring because the annual recurring revenue guidance was raised significantly. The expectation was that this high growth would continue unabated, driving the multiple higher. The reality of the losses, the high price-to-sales ratio of over 283, and now the complex, costly acquisitions are creating the counterpressure. When you couple that with the inclusion in the Russell indices, which forces passive funds to buy, you get a short-term liquidity boost that can mask underlying operational issues. The index inclusion provides temporary stability and credibility, a validation that institutional investors on platforms like Fidelity or interactive brokers might appreciate. But it doesn't solve the core problem of heavy losses and a high-risk business model. The question now is whether the institutional support, with major players taking positions, will be enough to stabilize the price against the short-term negative reaction to the complexity of the new M&A strategy. Citadel, BlackRock, and Vanguard taking new positions is certainly a vote of confidence, but their conviction is being tested in real time by the company's aggressive spending and strategic redirection. Drilling down to the company's core business, Rezolve AI PLC is a UK-based pure-play artificial intelligence company that offers its proprietary large language model, called Brainpower, specifically for the retail and e-commerce sectors. Their aim is to use AI to improve search, personalization, and checkout experiences for major retailers like Ferrero, H&M, and Urban Outfitters, which are already named enterprise customers. The pitch is compelling. Use AI to reduce cart abandonment and increase average order value. The technical performance of their LLM, particularly their empathetic 128K and single GPU 27B models, which they claim outperform competitors in retail-specific scenarios, is the bedrock of their long-term growth story. The business model is classic software as a service, with reported gross margins of 95.8%, which is excellent and provides the high-margin foundation that investors crave. This high-margin growth is the key to the optimistic $500 million ARR target for 2026. However, that SaaS model is now being mashed together with the decentralized finance and data platform model through the Subsquid acquisition, which is a major divergence from their stated specialization. While their existing product suite offers features like geolocation campaign activation and one-tap checkout, the new focus on digital asset payments through SmartPay and the data layer from Subsquid suggests the company is attempting to capture the entire vertical stack from AI interaction to final settlement. This vertical integration is a massive undertaking for a company of Rezolve's size and financial standing. It's an ambitious approach that either solidifies its status as a market leader or stretches its resources past the breaking point. The future outlook for RZLV is defined by its ability to execute on these extremely high growth and complex targets. The most immediate catalyst is how the market processes and re-rates the stock following the blockchain infrastructure acquisitions. If the market begins to see Rezolve AI as a leader in a new agentic commerce category, which management has explicitly outlined, that merges conversational AI with native digital asset capabilities, the stock could find a new higher valuation floor. The risk, conversely, is that the massive spending required for M&A, global sales expansion, and continued R&D, combined with the legal headwinds from the financing lawsuits, drains the capital it recently raised. They ended September with a strong cash position of approximately $230 million, which is crucial. But that war chest can shrink quickly in this kind of high-stakes expansion. For anyone considering an investment in this space, you have to weigh the potential for a 36 to 100 times revenue multiple seen in other AI peers against the reality of Rezolve's negative profitability and aggressive corporate strategy. The consensus price target from some analysts is around $10.50, but reaching that depends entirely on the market's belief in the $500 million ARR guidance, which is a monumental ask. This stock is not for the faint of heart or for someone looking for low-risk diversification through something like Fidelity ETFs or a basic online investment account. This is a pure bet speculation play on the future of AI and digital payments in retail. The next few quarters will not just be about hitting sales targets. They will be a race against the clock to prove that the current business model and the new acquisitions can be harmonized to deliver profitable growth. This current volatility makes an argument for both bulls and bears. The bulls point to the massive growth in ARR and the institutional validation from major funds now on the cap table, arguing the stock is still trading at a significant discount, about 17 times forward ARR compared to peers. The bears, however, see the widening net loss, the ongoing legal drama, and the dramatic distracting shift into cryptocurrency payment infrastructure as a sign of a company overextending itself. They see the high PS ratio and the negative Altman Z-score, which suggests financial distress, and argue that the market is simply correcting an overblown speculation. The truth is, as always, somewhere in the middle. Rezolve AI has built a high-margin, high-growth engine, but it is fueling that engine with high-risk capital maneuvers and costly acquisitions in completely different tech verticals. This creates a fascinating tension for any self-investing individual or professional analyst. Before you decide which side of the trade you are on, I want to hear from you. Comment below how many shares of Rezolve AI RZLV you currently hold, or what you think is the biggest risk for this company right now. In summary, the expectation driving Rezolve AI stock has been simple AI hypergrowth,